Good afternoon, everyone, and welcome to this great session, the panel of regulatory and policy. My name is Sandeep Dahiya. I am a professor of finance here at Georgetown University Business School. I'm also the faculty affiliate with the Pissarro Center for Financial Markets and Policy, and it's my honor and great pleasure to introduce the panel as well as the moderator. We have the SEC Commissioner, Mark T. Oyuda. He was sworn into office on June 30th, 2020. He was nominated by President Joseph Biden earlier this year and confirmed by the US Senate on June 16th. Commissioner Oyuda has served on the staff of SEC since 2006, including as senior advisor to Chairman Jay Clayton, senior advisor to acting chairman Michael C. Pivovar, counsel to Commissioner Paul S. Atkins, and various staff positions in the Division of Investment Management. He most recently served on detail from the SEC to the Senate Committee on Banking, Housing, and Urban Affairs as a Securities Counsel to the committee's minority staff. Prior to joining SEC, Commissioner Oyuda served as the Chief Advisor to the California Corporations Commissioner, the state's securities regulator. He also worked as an attorney at law firms of K&L Gates in Washington, D.C., and O'Melveny and Myers LLP in Los Angeles. And he is also a Georgetown graduate. Welcome, Commissioner Oyuda. Our other panelist is the CFTC Commissioner, Christy Goldsmith-Romero. Commissioner Goldsmith-Romero was sworn in as CFTC Commissioner on March 30th, 2022, after being nominated by President Joseph Biden in September of 2021. And she was unanimously confirmed by the US Senate. Prior to becoming a CFTC Commissioner, Commissioner Goldsmith served for a decade as a Special Inspector General for TARP, a role for which she was nominated by President Barack Obama and unanimously confirmed by the Senate in March 2012. In that role, she led a nationwide federal law enforcement agency and watched over TARP, a program where the US government became, as we know, shareholder in banks, automotive industry, insurance industry, and she owned, exchanged, and traded in corporate securities and derivatives and administered foreclosure relief for the consumers. Commissioner Goldsmith also served on the staff of U.S. Securities Exchange Commission. She served on the executive staff during the financial crisis as counsel to SEC Chairman Mario Shapiro and Chairman Christopher Cox. In that role, she advised the chairs and served as the liaison to SEC Commissioner and staff. For 4 years, she served as the senior counsel in SEC's enforcement division, where she investigated securities law violations, including those related to financial institution fraud, insider trading, hedge funds, and retail investor fraud. Welcome to the panel. And of course, it's my pleasure to now introduce and hand over to the moderator, Michael Pivovar, who is the executive director of the Milken Institute Center for Financial Markets. Mike has deep connections with Georgetown University and the Business School. He received his MBA here. He is a distinguished policy fellow, as well as the member of Board of Advisors at the Pissarro Center for Financial Markets and Policy. He served as a commissioner at U.S. Securities Exchange Commission from August 2013 to July 2018. He was first appointed to the SEC by President Barack Obama and was designated acting chairman of the commission by President Trump from January 2017 to May 2017. He was previously the chief economist for the U.S. Senate Committee on Banking, Housing, and Urban Affairs under Senators Mike Carpo and Senator Richard Shelby, and served as the lead Republican economist on the 4 SEC-related titles of the Dodd-Frank Act and the Jobs Act. During the financial crisis and in its immediate aftermath, he served in a 1-year fixed-term position at the White House as a senior economist at the President's Council of Economic Advisors in both the George W. Bush and Barack Obama administrators. Before joining the White House, he worked as a principal at Securities Litigation and Consulting Group. So I hand over the charge to you, Mike. Thank you so much for being here and welcome.
Great, thank you, Sandeep, for those very kind introductions, and I also want to thank Mike Pissarros for your transformative gift. I've been at a number of these conferences. It's always the go-to conference here in Washington D.C., but today there's especially an extra buzz around. So, and a lot of it is large part to do what you did. I understand from the various professors that a number of students want to ask questions of our distinguished guests here. So we're going to make sure that we leave at least 15 minutes to do that, and we'll make sure we do that. So we've got all the introductions out of the way. Because we have two commissioners here from federal agencies, I believe there's a little bit of a housekeeping announcement that each one of you has to do. So Commissioner Ueda, would you like to go first?
Sure. Well, thank you. And thank you for that wonderful introduction. It's really great to be back here on the hilltop. I think I was back here maybe 2 name changes ago when I was a student. It was the School of Business Administration before it became the Georgetown School of Business, and now the current name. So really glad to be here. I lose track sometimes over time. This was a baseball field. The Southwest Quad was a parking lot. So it's really nice to see all the change. And yes, my freshman year advisor was Dean Agarwal. So yeah, follow her advice, you too might become an SEC commissioner. But yeah, as Mike mentioned, I am one of 5 commissioners. So the views I express today are my individual views as a commissioner and not necessarily reflect those of the commission or the other commissioners.
Thank you. It's just really thrilling to be here. I've been an adjunct professor at Georgetown Law. So I've been invited over there to speak, but I've never been invited here. So I hope I don't flub it up so I can come here again. But it's really great to talk to you today. I also have to give the disclaimer, the standard disclaimer, that the views that I'm going to give are my own views as a commissioner and do not necessarily reflect those of the commission or any other commissioner.
All right, with that out of the way, let's get started. So in the introduction, Sandeep mentioned, your deep background in federal service. You have a lot in common, that your backgrounds have prepared you well for your current role. You both served on staff of the SEC. You both served as counsels to former SEC commissioners. In addition, you've served at other agencies. So Commissioner Goldsmith Romero, let me start with you. You worked previously at the SEC, now you're at the CFTC. How are the two agencies similar, and how are they different?
So I get asked this question all the time. They're more similar than different. And I think that's really important. First of all, it's a lot of the same companies before us, right? So a lot of these, whether they're exchanges or brokers or clearinghouses, a lot of them are dual registered. And then it's the same idea, the same mission of trying to make sure that markets are working well. So all of that is the same. Where there are a couple differences. The first is that we are including, along with financial derivatives in commodities, which right now, if you look at what's happening with energy prices, with agriculture, when you look at oil, gas, wheat, particularly with what's happened after the pandemic, supply chain disruptions, and Russia's invasion of Ukraine, there's a lot of impact on that. So that part is different. It's been fascinating to get deep into that and to use the skills that I had at the SEC. Second difference is that there's just more of a retail investor protection focus at the SEC. But I come into it with that view, and then that ends up, as our markets start to have more retail interest, I'm always using those experiences and using that view.
Yeah, so I was going to ask you. So from the SEC, is that the biggest thing that helped shape your view as a CFTC commissioner, the focus on retail, and we'll get to that a little bit later in the discussion.
So I think the biggest thing that shaped my view was was the financial crisis. So working for 2 SEC chairmen in the run up to, and then during the financial crisis, moving over to Treasury, where I headed up an office that was working to respond to the financial crisis, build a stronger, safer financial system. Because of that, that is, I think, the single most thing that colors my view. I'm always going to be focused on financial stability. However, that retail investor protection focus will always be there for me.
Great. Commissioner Ueda, so you've served at the SEC for about 16 years-ish. You've also served on details to the Treasury Department, the Labor Department, Senate Banking Committee. Going outside the SEC, how has that shaped your views, with the SEC within the broader framework of the financial regulators?
I think those experiences were incredibly important. One thing that you realize is the longer you're in a professional career, oftentimes you get more and more specialized. But then when you get to the role I played as one of the 5 commissioners, you need to think about everything. And my particular background was in asset management and corporate finance. And we do a lot of things right now that deal with the markets, the exchanges, the broker dealers. And that was not what I had done at the SEC. In fact, when I went to Treasury and I interviewed, I knew they wanted to do some things for the detail over there in the capital formation space. but the person who I'd be working for, his first question was, "Oh, let's talk about market structure. And what do you think about order execution quality and a lot of other things?" And all of a sudden I had this nice pitch about what we need to do to stimulate capital formation, the important role that the asset managers play. And now I'm been really getting into the nuts and bolts of the plumbing of how the markets work. Turned out one of the purposes from this particular boss was, he said, "Well, I want my folks to always be wanting to learn more and to be always willing to tackle new challenges." And so from there, you mentioned went to labor, was working on their policy staff, and then at Senate Banking. And in those roles, you're the only person from the SEC. So of course everyone assumes you know everything about the SEC, when again, reality is that you have these specialized areas. But starting with the experience at Treasury, learning about the much broader view really helped get a more comprehensive view of how the interaction between the markets and the law and the rules worked. And where this really paid off was, I think it was 3 or 4 weeks after I started at Senate Banking. And so end of January 2021, all of a sudden I started getting calls from the ranking member. "Hey, turn on CNBC. What's going on with GameStop?" And all of a sudden, all of the issues that went there between broker dealers, capital requirements, clearance and settlement, margin, short sales, the role that private funds were having, but having gone through looking at this holistic view at Treasury and labor, gave me a lot more confidence. Okay, here are the issues that we need to be looking at. Here's who we need to be talking to understand this better. And then now, sort of the fourth time, so to speak, when I hear in my commissioner role, for me, it's like the fourth time having to think about things at a holistic level. So that has made the transition a lot easier.
Can I add something
sure.
onto that? So that's interesting that you raised that about Treasury, because that's exactly what I felt. Like, we're at the SEC, very focused on markets. When anyone who goes to Treasury, you're focused on the economy. Once you start to focus on the economy, you never lose that. So now I'm at the CFTC, you're at the SEC. And what I'm looking at now is how is what we're looking at in the markets or whatever tied to the greater economy. How does what's happening in the commodities markets right now impact Americans or other people globally when they go to the grocery store, when they go to fill up their gas tank, when they have to decide whether to heat or cool their house? And so as we think about that, everything that we do in the greater economic sense, and we tie it to the greater economy, it becomes more impactful, it becomes more meaningful. Then you start to look at all these sort of economic indicators as well, as opposed to just market indicators. I think that more holistic view makes us better informed as commission.
That's great. So I want to drill down into 3 areas that are the current focus at both commissions, and also the 3 areas of focus at today's conference: ESG, market structure, and digital assets. So let's start with ESG. Commissioner Goldsmith Romero, you talked about energy prices.
Right.
The Biden administration has prioritized climate risk as a focus for financial regulators like no other administration. And you've talked previously about the CFTC's role in addressing challenges to energy infrastructure and the need for the CFTC to promote market resilience to climate-related risk. Talk to us about why is this issue so important to you, and why is this an issue that's so important that should be important to the folks in the audience?
Yeah, so I think what we're seeing is this impact as we have climate events that are happening now with increased intensity, increased frequency. They are interrupting supply chain. It is causing damage to energy infrastructure. Obviously, we're seeing severe damage to agricultural crops. When you have droughts, when you have fires, when you have flooding, it may not affect just this year's crop. It may affect next year's crop. So as I'm at the CFTC, there's this very clear line on climate and our markets, because for a very long time, for years and years, the derivatives markets were used to hedge risk related to weather. And so it's still being used in that way. And so if it's going to be used in that way, one of the things we need to do is assess the risk. That's number one, assess the risk. And I think we need to enhance our ability to identify risk and assess the risk in the markets and our market participants. 2 is promoting market resilience so that you don't have market swings when something happens. You don't want that. And so one of it is sort of working with the exchanges, working with the clearinghouses, and also just on their own, what is their own climate plan should something happen? And so one of the things we're doing is we're putting out for public comment just this very broad request for information about where we should be in this space, how we can help. The last place is voluntary carbon credit markets. I don't know if you guys are getting into this, but obviously, you know, there's a lot of net zero pledges out there. And so not everyone can reduce their carbon emissions to meet that. So they then want to buy credits. So then there has to be a market for those credits. But how do we ensure the credibility, that it's high quality, that there's no greenwashing, that there's no double counting? And so how, as market regulators, can we step in and facilitate that so it's available to market participants?
Thanks. So Commissioner Ueda, there's a lot of discussion earlier at the conference about the SEC's proposed rule to enhance climate-related disclosures. Now, I know enough that's because that's out for public comment. If I were to ask you about that, you'd say, I can't comment on that. It's out for public comment. So I want to ask you a broader question about broader ESG issues, right? Given your service at other places in the federal government, and we had in an earlier panel today, Joe Amato mentioned how the DOL's view of ESG in terms of how it fits with fiduciary duty tends to go back and forth depending upon the administration. Can you talk about what ESG related issues that you worked on at DOL or Treasury or on the Senate Banking Committee?
Yeah, I think one of the key issues with ESG is just definitional. Is it ES and G, or is it ES or G? Because when you break it down, how you weight them, what's in and what's out. For instance, let's take the G component. And especially when we think of what may financially be material to evaluation of an enterprise, or looking at whether the stock price is correct, or at least we're trading where you think it ought to be. Dual class stock. Do you have a controlling shareholder? Is your board staggered? Or is it just they're all elected annually? Is there a poison pill? These are all things that for decades, if you're doing financial analysis of this company, you're going to be thinking about as affecting your valuation. So that is nothing particularly new. Environmental, there are lots of different facets in the environmental part. Social, that's probably one where I think I've heard a lot of different definitions on it. Some have asked, is cybersecurity risk, is that a social issue or is it not? Supply chain management, is that fall under S or not? And then if you combine them all together, how do you weight those? Do you weight them evenly? Some might put higher emphasis on certain climate change factors. Others may put more importance on governance. Different people making these assessments oftentimes have different views as to how they ought to be weighted, which is why if you look at some of the evaluations of ESG ratings, you'll find there are different opinions, how they weight, what they include, what they don't. So there is no particular definition of what is ESG. And that was something that came up when I was at Labor, and we worked on some rules about ESG. And so the original proposal talked a lot about, well, if this is environmental or social or governance, you need to make sure that it still is financially, it basically affects the pecuniary value of an investment. And then we came back and did the final rules. We dropped all references to ESG because it was really difficult and a struggle to find exactly what that encompassed. And instead you fall back on what has been, what I think almost tried and true throughout modern investing, which is any particular factor is material if it would be important to your valuation of a company. And that differs depending on your particular company. And some, think about a real estate investment trust that has significant amounts of coastal properties that may be negatively affected by a rise in sea levels. Material. A rise in sea level may be less material to some company that has no customers or revenues coming out of coastal areas, or that would be affected, or it's dependent on shipping overseas or things like that. It is all very, very specific. And so going back to what is financially material is at least the lens that I think about these things about ESG. And so you can have any particular factor can be material, but it all depends on a particular company.
All right, let's move on to market structure. And Commissioner Ueda, let me start with you. You mentioned being on the Senate Banking Committee during the meme stock trading frenzy of 2020. Just like any sort of market dislocation event, whether it's a flash crash or meme stock trading or a book coming out about algorithmic trading or that sort of stuff. For a brief period, Jim Angel and other folks and I who are market structure nerds get joined by a lot of people who get really, really interested in market structure. And then they realize it's really, really difficult, which is why we need to have conferences like this to talk through the issues and stuff like that. So as someone who has to be a market structure nerd and has to think about these issues, what do you think are the most fruitful areas of equity market structure reforms that the SEC should focus on?
Yeah, well, you're right. This came up when I was at Senate Banking. And one of the most interesting things in my experience at Senate Banking is you always have to have your TV on, because you just never know when breaking news like what happened in January 2021 occurs and everyone starts chatting about it. I think there are a lot of issues out there. And Chair Gensler, I think it was in June, gave a speech about articulating some of his thoughts on market structure, at least at that time. And I know our staffs continue to work on them. I think he laid out three very important topics that definitely worth further consideration. One is the pricing increments on the exchanges. It's now been, I think, about 20 or so years since we did Reg NMS, and we went very significantly from to shrink that to a quote of a penny. But now, is it appropriate to have it sub-penny increments, which is what they are trading when you go through some of the wholesalers. Another one is the national best bid or buy offer. I'm getting that wrong. I'm not a market structure nerd like you, Mike, but the NBBO, as we like to call it, national best bid or offer. That is in large part how at least one metric in which you could evaluate execution quality. But how you calculate that NBBO is important. And so that was something that Chairman Clayton looked at. Chairman Gensler is suggested maybe we need to think about speeding up some of those reforms because just trading on round lots, which is how it used to be, and doesn't make sense for really high price stocks. And the third is looking at some of the disclosures, what we call Rule 605 disclosures, but it has to order execution quality. Again, hasn't been looked at for almost 20 years. So I'm a big proponent. You need to go back and take a look at the rule book. Those changes may have been perfectly appropriate for around the turn of the century. But now here we are 22 years later. As we think about what we should be doing for the next 20 years, let's go back and revisit and evaluate. Can it be more effective? Can it be more, provide better investor protection?
Yeah, so those are great areas to look at, the issues that people in terms of the approach. How would you? So you mentioned Chair Gensler gave that speech in June, laying out a bunch of different areas he's going to look at, and people are wondering whether his preferred approach is going to be a comprehensive, just like a big bang, like drop it all at once, or is it going to be more of an incremental deal with them, sort of on a piecemeal basis? Do you have a preferred approach?
I think the staff's working on that. You're right. There are a variety of ways we can do this. Sometimes we've done a very comprehensive proposal and then might adopt in parts of it. When I was a junior associate, first getting in the corporate securities area, the SEC came out with what they called the aircraft carrier release, which was a lot of different capital formation ideas. And then that release itself never went anywhere. We used to joke, well, the aircraft carrier sunk under its own weight. But what you look at that is, things such as, Form S3 and the shelf offerings, and a lot of those things all were part of that, but those then were subsequently implemented in its own right.
Good. So Commissioner Goldsmith-Romero, you mentioned retail investors coming to the CFTC regulated markets. In today's earlier market structure panel, there was a lot of discussion about how retail investors are driving prices, and also the regulators have to focus on it in the equity and the digital asset market. So interested in your perspective. CFTC, which has traditionally been institutional, you said it's becoming more retail. Who are these new retail investors?
Yeah, so I think if I asked everyone here to, if they were comfortable to raise their hand, if you've ever owned crypto, here you go. I mean, in all seriousness, I think right now, mostly digital assets, right? So I think the latest statistics are 1 in 5 Americans. And so we have to think in a different way. Bitcoin is a commodity. And what we regulate is the future on that, a Bitcoin futures, an Ether future. What is not regulated is Bitcoin. What is not regulated is what we call the spot market. So when we think about retail, when you're buying something like a digital asset or anything, we're all used to using apps, right? But the apps for unregulated purchase of cryptocurrencies look very much like other apps. And what we don't want to have happen is for people to think that this is a regulated market. It is not a regulated market, largely unregulated, without the guardrails, without the customer protections that would normally come with, if you have a broker dealer. The other thing is a lot of the retail coming in young, I think 40% buying crypto earn less than $50,000. A lot of them don't want to go through a broker. So we get into these sort of direct to consumer models, and we have to think through that. So we have this very, very broad definition of retail at the CFTC. It's all those people making under $50,000 to $10 million millionaire, a hedge fund with 4.9 million. This makes no sense, right? It might have made sense for the markets I just described, but it makes no sense today. So today I'm announcing that I am trying to come up with I'm proposing a new definition of retail that divides between household retail and then professional and high net worth. And therefore we can tailor rules to one group and the other, because we do have to think about things like suitability. We have to make sure that customers, investors are informed about what they're investing in, who has the duties, particularly if there is no broker. And so we have to think through all of those issues. And so what I propose is that we break that definition of retail into two, and then we can target rules and regulations to regular household people that may not be needed for a hedge fund or a millionaire. And then we can expand access. There's a great opportunity to expand access to financial markets here. But President Biden's executive order says the U.S. has an interest in expanding access in a safe and affordable way. And so we can target what safe and affordable is for those two different groups rather than trying to collapse them in one.
Good. So the retail investor definition, you said, is very, very broad, and you want to work on that. That's great. What's also very broad is the definition of commodity under the Commodity Exchange Act. In fact, it's so broad, it exempts things specifically like onions and box office receipts things like that out of there, right? And in terms of digital assets, virtually all digital assets seem to fit within the legal definition of commodity because it's so broad. And that means they generally fall under the jurisdiction of the CFTC unless they also meet the legal definition of a security, which means they'd fall under the jurisdiction of the SEC. So I'm tempted to just call out when you guys divvy them up and see who gets jurisdiction, but I'm not going to do that.
We will break the internet. If we're doing that, we're going to break the internet.
Yeah, exactly. And so it's been discussed early in these panels, digital asset market participants have been calling for greater legal and regulatory authority. Some has to be done at Congress, some can be done at the regular. So let me ask you both about sort of the legal and then the regulatory piece. And Commissioner Ueda, let me start with you. What do you think would be the most important thing that Congress can do to help either clarify existing authorities or grant new authorities to either or both agencies?
Yeah, so Congress is definitely thinking about this issue as, as the way I look at my role as a commissioner, it either falls into the SEC's jurisdiction or it does not. We have a definition of a security. I think some of the problems come with what are the parameters of that. We have very principles-based tests commonly used in this space, which is called the Howey test, which is off a Supreme Court decision, which basically says, does this involve an investment or scheme that involves the use of money to acquire a common interest in an enterprise with the expectation of profits from the managerial or entrepreneurial efforts of others. We oftentimes think principles-based rules are good because what we're trying to get is at the economic substance and not sort of formalities of why we even have the securities laws existing in the first place. However, how you apply these particular prongs of how it can be difficult. I've had to do it myself, but not with respect to digital assets, but going back to 17 or 18 years ago when I was a state securities regulator trying to apply the Howey test, and you go through each prong, but it's not the easiest analysis to do. We've now had a chance to take a look at lots of different scenarios here, and it's one where, okay, we should be thinking about, can we provide further clarity as to where we think, what is a security, what is an investment contract? And I should also add that investment contract is not the only type of security under the securities laws. There are other things. It could be notes, debentures, collateral certificates of trust, and a whole litany of other things. So be encompassing here, we should not try and hide the ball. You know, I know this is sometimes come up, for instance, on certain types of offerings where, well, what if there's no expectation of profit? Does it get you out of Howey? But maybe it gets you on one of these other types of things. So providing that sort of clarity, I think would go a long way to allowing participants in this area to understand what their legal obligations are and to comply with them.
Yeah. So what is not a security? So Commissioner Goldsmith Romero. So in terms of congressional authority, you mentioned, you know, you don't currently have regulatory authority over the spot market. You do have anti-fraud, anti-manipulation, but would that be the number one thing that Congress could do? Or
I mean, I think it has to be. I mean, everyone raised their hand here and you're investing. You want to invest in a regulated market. I mean, so I think we just start there. Let's start at the top. Let's get it regulated. Let's get the exchanges, including the ones on the Super Bowl ads or, you know, that are being targeted out to retail people. Let's get the exchanges, the clearinghouses, the brokers. Let's get everyone registered. Let's all get on this level playing field about what the guardrails are and the customer protections are. And then at least people then are buying crypto in a regulated environment. So I think we really start there. I mean, I think that's the broader thing that people need.
All right, so let's move from legislative down to regulatory. And Commissioner Goldsmith, let me stay with you. What's the most important thing that you think you could do as a commission to provide regulatory clarity?
So right now we are allowing crypto futures. It has been for 5 years. Those products are starting to grow. And then what we're seeing is an uptick. So those regular crypto companies are now filing to register with us or buying one of our registered exchanges or clearinghouses. So this is, again, on the future side, think Bitcoin futures. When they come in, they may want some kind of relief from our rules. So the question is sort of how bespoke do we make it? And I sort of go with this same risk, same regulatory outcome. And so what we're constantly doing is trying to evaluate the risk. I don't want to move too far away from a regulatory system that has stood the test of time and worked. So a lot of times these companies will come into my office and say, maybe the commission needs to move more towards us. And we say, maybe you need to move more towards us, to the regulated environment, because you have operated and set up your business in an unregulated environment for so long. If you're saying you want to be regulated, you need to move more to us. And so I think making those decisions on those types of matters become really important. Let me give you just one example. I think this is one of the most important examples that's out there. It's called segregation of customer assets. Where is your crypto? Who holds it? Is it commingled with the companies? And what happens if that company goes belly up in bankruptcy? Usually, if you're talking about brokerage account, investment account, 401k or whatever, those are your assets. That is not the case most of the time in crypto. So that's just very, very basic. And I think all of us are so used to in America, we have this money, we have this asset, we have it in an account, that's ours. That's ours to win, lose, make money, lose money, take out when we want. It's just not the case with crypto. So something as simple as that, but also as foundational of that is really, really important. And that's why I think more of this this industry needs to come within the regulated space to try to protect people, because otherwise I think the most vulnerable people are going to get hurt.
Yeah, no, I think to your point about the segregation of assets or the non-segregation of space is very, very important. I think was it Coinbase in their 10K had to disclose that, you know, if they went bankrupt, that you would basically get in line with the other general creditors. And people went, what? And it's like, no, it's not a broker dealer where you have, you know, SIPC protection, where you have, you know, you get ahead, you know, there's a separate protection, all that sort of stuff. So Commissioner Ueda, the same question. What do you think could be the most important thing that your commission could do to provide regulatory clarity?
Yeah, so once you get past the first question, is this a security? If the answer is yes, well, then what? What comes next? What does it mean in terms of, we're just discussing custody of those assets? What does it mean in terms of broker responsibilities, is how they apply their, for instance, best interests? How does it apply to clearance and settlement? How does it apply for asset managers? I mean, if it is a security, you could put this potentially into some sort of fund. So all of these questions come out, and then you realize, and I should have added one of the biggest ones, what does disclosure look like? For some of these, if you conclude a particular digital asset as a security, okay, here are my GAAP financials. Doesn't really apply, or at least you would need to make sure you understand how that would apply in the context of something very different than from an operating company. So all of those questions, and in part, I think one of our jobs as a regulator to do is still sort of lay out, here is our expectations. And one of the things with the SEC is we've got a whole toolkit, everything ranging from no action letters to exemptive relief to our rulemaking ability to try and, as well as sub-regulatory interpretations to help get us to the right place. So, you know, when you think of having an appropriately tailored regulatory regime, that's one where the effective regulations doesn't in fact strangle the market, but in fact helps the market prosper.
Good. So far we've been talking about what your agencies could do individually. We had an earlier panel today where Jim Angel said financial regulators don't always play well together. So do you play well together? And more specifically, you know, have you all been cooperating on digital assets? Right? Sometimes it's no, it's a commodity, no, it's a security. Kind of go back and forth on this. How have you been working together on these issues in the meantime? Commissioner Ueda, let me stay with you.
We cooperate tremendously. I mean, at all levels, I'd say, all the way from, I mean, at the commissioner level down to our staff level. We cooperate internationally. We're both part of IOSCO as the two market regulators for the SEC. Both agencies are part of the president's working group on financial markets, are also both part of the Financial Stability Oversight Council. So at all levels, we cooperate. And as the Commissioner said earlier, we get a lot of dual registrants. And so they expect us to cooperate, because the last thing they want are regulations that are inconsistent or seem even at worst at odds with each other.
Yeah. So similar rosy scenario. Is Commissioner Ueda playing nice with you all? Is any complaints?
Are you playing nice today? Yeah, it's really, there's a long history of doing this, all the way down to the different divisions, enforcement, the operating divisions. I mean, we're constantly talking back and forth. There is dual registrants. And then for myself, I mean, Mark and I and Commissioner Peirce all served together on the 10th floor at the SEC at the exact same time. We've been friends for a long time. I am friends with the other commissioners and the chairman. We talk regularly. I mean, just to give you a sense, today, I have had communications with 3 SEC commissioners today. I mean, it's just a constant back and forth because we all care. We want to try to get this right. We're not looking to have anything fall through the cracks. And that's the most important thing. And to do that and to have this mission, we're trying to give markets to work well. We're trying to make sure that we're covering the full land. I mean, we have to work together to do that. There's only 2 market regulators in the United States. And so we've got to work together hand in hand.
Good. So the market regulators play nice together. So Jim, it's the banking regulators that are the problem. I see. So let's go ahead and open up to questions. Again, priority for students. Other folks can ask questions too, but I can see some people starting to work their way down. I know there was a number of folks that wanted to ask questions on there. And then you just please state your name and your affiliation. If you're a student, just say what year you are, that sort of stuff. Izzy, do you want to go ahead and go first?
Hello, nice to see you all again. It's been about an hour. My name's Izzy Johnson. I am a second-year Master of Public Policy student here at Georgetown. And my question is, so as the SEC and CFTC continue to work on things like ESG and crypto, how do you see agencies navigating a more restrictive enforcement and rulemaking space in the wake of Supreme Court decisions like West Virginia versus EPA?
So certainly that decision needs to be taken into account, as well as the whole major questions doctrine. I see that, I think, more in the rulemaking side, because you get those comments out there. People ask about your statutory authority. Less certain how that might apply in the enforcement context. For instance, the SEC, we fairly broad what we call anti-fraud authority, including prohibitions against use of manipulative schemes. We're also making false and misleading statements, including false and misleading impressions by omission. But going back to how we look at that, it goes back to whenever we do a rule, we take very seriously, well, what's our statutory authority? What was the congressional intent behind it? In some cases, we get very, very clear directives. There were a number of provisions in Title 15, for instance, Dodd-Frank, which said the SEC will do mine safety disclosure rules. They will do disclosures on Congo conflict minerals. Other legislation in the past has dealt with things like with Iran and Syria. So we don't have an issue, of course, when we're doing those sorts of disclosures, and it's been clearly instructed by Congress to do so.
That's a great question, Izzy. It really is, and it's something that's on the mind of a lot of agencies. And I went down the rabbit hole on like a number of podcasts on the Supreme Court decision, and it's very interesting to see how it's going to play out, because there was this very specific EPA rule that a lot of people sort of warned had some issues. And so, right now I'm not looking at it as much broader than that. We're going to try to see how it plays out in courts. But one of the things we do all the time is that we're seeking public comment. And part of that public comment, like I talked about the climate risk area, we put out requests for information. And in there, and I helped write those, and I sort of wrote in, what is our authority? What should we do in our authority? What is outside of our authority? And so you're not sort of just having groupthink within the agency. You're looking at sort of all of this and saying, what is the right thing to do? Are we the right one to do it? I think it'll be very interesting to see how the case law plays out. And for those of you who haven't dug into the actual facts of the case and that EPA law, it's worth doing it, because it does sort of maybe look a little less scary from a federal agency perspective, and you sort of actually look at the law that was at play.
Hello, my name is Connor Riley. I'm with the Cato Institute. I was wondering, how would you guys say not being able to own or interact with crypto has affected your education process, and then trying to regulate it? Because to me, just using this stuff is the best way to learn about it.
Well, before you answer, I'm with you. When I was a commissioner, I wanted to get ethics approval to own crypto, and they wouldn't let me own it. And I said, well, why not? And they said, well, it might be a security. I'm like, is it? I'm like, we don't know yet. And I'm like, well, should I be able to do it? So I am with you. So, right. So now I wish they wouldn't have bought it after I left the commission, because the price is down. But anyway,
yeah, so I actually got interested in the subject of cryptocurrency quite a while ago. I worked on the financial crisis, and then I worked on TARP, the bailout. And I've worked very hard to hold Wall Street accountable. So the concept of what crypto was born out of, Occupy Wall Street, get away from the system we had where the big banks, I mean, it comes sort of directly out of the crisis, was very intriguing to me as where it could go. So I kind of got very deep into it, started learning this several years ago, just out of pure interest. I actually developed a cryptocurrency class that I taught at the University of Virginia Law School. So, you know, one of the things it does, not owning it, is I have no conflicts. I have nothing, you know, I'm not trying to make any money based on any policy decisions. So I'm completely free of that. It's not that I have to have the user experience necessarily in the trading of it or the opening of the account, sort of know everything. I mean, we are able to gain information, but this is something that it's one of the reasons why when the White House asked me what I was interested in, I said the CFTC in part because of this.
One of our obligations as a commissioner is to act with our duty, inconsistently with our duty of care, which means understanding what we're doing, why we're doing it, having a rational basis for that. I don't think that needs to be, you actually own it. For instance, another issue that we have right now has to do with what we call the 144A securities. This has to do with this, how one of these really technical rules called 15C211 is being applied, but it affects qualified institutional buyers. I am not a qualified institutional buyer. I doubt I'll ever be, have the assets to be one, but we're asked to render judgments on that. So those are the types of things where you need to understand thoroughly what's going on to come to that conclusion. You know, we're lucky that we have a workforce. Many of them have expertise on this. And then, as Commissioner Romero said earlier, the public comment process also. So frequently that comes into play. So that's how we also gain that knowledge and expertise. So it's not just our own staff, but we hear from the public.
Good afternoon. I'm Rahul. I'm a Georgetown alum. So crypto is obviously has a uniquely international attributes to it, being decentralized. How are you informed, and how do you sort of think about regulating it in the US you know, looking at international regulation as well? You know, countries like Canada, obviously, Singapore, China, that are doing it differently. How are you informed by it, and how do you think about it from that perspective?
So definitely, I'm looking at the experiences in other countries. So while a lot of these decentralized offerings are global in nature, you know, our laws, if it is a security and it is offered or sold in the United States, you fall under our jurisdiction here. And so, and if it is a security, then it would fall within the SECs. So I you know, depending on the offering, I think there are some offerings that they take a great amount of care so that it is not offered within the jurisdiction of the United States to specifically avoid entangling themselves potentially with the SEC. But looking comparatively at what other jurisdictions, I mean, not just for crypto, but for a lot of other things. You know, Mike talked about, we were talking about ESG earlier. I'm definitely looking to see what the EU's experience is with the Sustainable Finance Disclosure regulation over there. Are there lessons to be learned that I can think about as we potentially craft our own approach to ESG disclosures? So it is important to have that international outlook. And I think we do a great disservice if we think all the best ideas come here from the United States. Well, no, there's lots of experimentation going on around the world. And we ought to learn about that before making our own decisions.
I mean, we're also just talking with our international regulators all the time. I just met this week with the chair of ESMA in Europe. I'm headed to London tomorrow. You know, we're constantly talking all the time. But as we look at our markets, the United States has the strongest, safest, deepest, most liquid markets. It is my job to make sure that continues. And so I am not going to allow anything that's going to come in and bring that house down. And so I'm going to continue to work on financial stability concerns and making sure that when we're doing it right. And that's why I say I don't want to stray too far away from a regulatory framework that has worked in the past. If it is the same risk, we really do need to have the same regulatory outcome.
Jim?
Thank you. I'm glad to hear this discussion of best execution. FINRA already has a principles-based rule 5310, which basically has influenced similar rules in the EU and other countries. Yet there's talk of an SEC rule. So what could an SEC rule do that would actually improve the user's experience beyond what we have now. That's part one for the SEC. And for the CFTC, with the increasing retail involvement, especially if you get more authority over crypto, what are you planning on doing on best execution? And are you playing nicely with the SEC on their current discussions?
So best execution is something that also Chair Gensler mentioned in his summer remarks earlier this year. So staff is thinking through those issues as he directed. Not all brokers are necessarily FINRA members. So FINRA has scope only over its jurisdiction, and as well as BestEx is a concept that also comes up under the Advisors Act as well, and not while you have some duly registered broker dealers and investment advisors, it is separate for the investment advisors. And not only in the advisor context do you have the SEC registered advisors, but you have the state registered advisors too. And oftentimes they want to look to a single standard. Interesting when the Labor Department, when I was there, came out with its own the replacement for the fiduciary rule that they had under ERISA. They did reference the best execution obligation under the federal securities laws. So that is one that, at least in the federal securities laws, has been largely shaped through case law, but not through an explicit rule. So we'll see. Like everything else, if a proposal is issued, we'll get public comment on that. You'll get the public benefit of, hey, here's what the SEC thinks about this and why it needs to occur. And hopefully, one of Mike's favorite subjects, there'll be a robust economic analysis accompanying that.
Right. And robust public comment from.
We'll get some good comments back.
So this, I'm so glad you raised this, because this is, I was just talking about this today, because this is a very interesting concept. So one of my concerns with looking at the crypto companies are the conflicts of interest. So you have a company, or it's either itself or its affiliate serving multiple roles. They can be the broker, they can be the exchange, they can be the clearinghouse, they can also be a market maker. So here, when you buy something on New York Stock Exchange, the New York Stock Exchange is not potentially taking something in favor against you, right? They're not market maker. So what happens in that scenario if that's the case with BestEx? Now let's take another thing. If you go to a direct to consumer model and you take out brokers, what happens with that? Where are the duties lie? And so I think what's happening right now is, when you have an industry that is used to having direct to consumer, we have to raise all these questions about, like, well, if you take brokers out, what's the fallout? All of the different fallouts, and how do you resolve these conflicts of interest with someone who's an exchange and also a market maker? There's a lot of issues that come into play. I think if we are going to get authority, that will come into play, but I also think it comes into play now in the derivative side.
Okay. All right, I think we have time for one more, two more, one more.
Hey, thank you so much for taking the time to come out. It's been a great dialogue. My name is Joshua Deese. I'm a DeFi lobbyist, a master student at GW studying legislative affairs. Most of my work has revolved around legislative advocacy, and now it's starting to creep into the regulatory side. I'm not a lawyer, and I'm not deeply embedded in the financial industry. And my economic policy background is more theoretical than in practice. So my question is, do you have any resources, primers, websites where someone might be able to get a more comprehensive understanding of the US financial regulatory system? And then, like, say I have, a foreign exchange client who is interested in penetrating the US market, how might I learn about that process?
Well, I was going to say, one of the things that I worked on when I was CW Treasury is we issued a series of reports, and a good chunk of it was describing how the financial regulatory system works. So this was under Executive Order 13772. And I think if you're looking for a primer, it's like the different the markets, different regulators, different applicable laws, and they've broken up into 4 volumes: banking, capital markets, asset management, insurance, and financial technology. That's certainly a good place to start. But I know there's lots of other places too. Congressional Research Service also has a number of things available on their website.
I mean, there's also the investor and consumer education that we do on our own websites and through our own agencies that you can look to. There's each of our websites has quite a bit of material on there. I think it's going to be sort of what are you looking for in what specific area, and then you can be able to pull it. There's also, may I just suggest, I don't know if this is going to be available at some point, but there's all kinds of these conferences and other things where if you have a specific issue, whatever it is, you can deep dive into it. And I think those are very helpful to hear the back and forth, a little more detail, and might be a little bit easier than reading, did you say the Congressional Research Service reports?
They've actually got some relatively short ones.
I mean, they're good. They are good. But if you want, if you want to get into sort of what is happening with crypto, I mean, I hope this is a little more entertaining than that.
Sure. Well, thank you so much. I appreciate
Thanks.
it.
So we're out of time. Commissioner Goldsmith Romero, Commissioner Ueda, thank you so much for taking the time to be with us here today. And so if everybody give them a round of applause, thank you very much.